After rallying nearly 40% in 2024, PayPal stock is off to a poor start in 2025, down more than 10% year to date, while the general market is up by about 3% so far this year. Over the past few days, PayPal stock has gone nowhere but down thanks to its recent Q4 earnings report, which highlighted a few things that turned off many investors. So in today's video, I want to talk about PayPal's Q4 earnings results, why the stock is selling off, and whether it's a good time to buy PayPal stock given the recent weakness that we've seen recently. Full disclosure, I do have a position in PayPal stock, so you might want to stick around to find out what I'll be doing with my position amidst this sell off. As always, you can read the article version of this analysis, which I'll leave the link in the description box below, so do check that out because I cover PayPal in much more detail in the article. And with that being said, let's take a look at PayPal's Q4 results. Looking first at the company's key growth metrics, active accounts for the quarter was 434 million in Q4, up 2% year over year, adding about 8 million active accounts year over year and about 2 million accounts quarter over quarter. In addition, monthly active accounts, which are accounts on average that use PayPal on a monthly basis, also grew 2% year over year to a record high of 229 million, reflecting improved engagement within the ecosystem. So it's great to see that PayPal continues to grow its ecosystem, which is a testament to its brand, its value proposition as a digital wallet and payment processor, as well as management's strong execution. On a less positive note, the number of payment transactions was 6.6 billion in Q4, down 3% year over year, and it looks like this is the first time in the first quarter ever where payment transactions declined on a year over year basis. So definitely not a good look at all. So according to management, this was primarily due to management's price to value strategy, which drove lower Braintree transactions. But if we exclude PSP or Braintree, the number of payment transactions actually grew 7% year over year. Moreover, transactions per account and transactions per account excluding PSP still grew on a year over year basis, as you can see right here, reflecting improved engagement and transaction growth in branded checkout, which is good to see because branded checkout, I believe, have higher take rates and higher margin, which contribute to higher earnings. So while payment transactions are down year over year, we're seeing good momentum in branded checkout, which matters more in my opinion. That being said, total payment volume or TPV for the quarter was $438 billion, up 7% year over year and beating analyst estimates by $1.1 billion. And even despite the decline in payment transactions, PayPal was still able to deliver record TPV, which is good to see. However, notice that growth has been decelerating over the past few quarters, which I believe made many investors uncomfortable. But if we look at TPV by segment, which is shown in this slide right here, you'll notice that the growth slowdown was entirely driven by the PSP segment or the unbranded card processing segment or Braintree. So PSP was growing very rapidly a few quarters ago. For instance, in Q4 of 2023, it was growing at 29%, but in the most recent quarter, it was only growing at 2%. So judging by this rapid deceleration in growth in the PSP segment, I wouldn't be surprised if we see negative growth in the first half of the year for this segment. Again, this was consistent with price to value strategy, but it's important to note that despite the slowdown in growth in the PSP segment, Braintree continued to contribute to transaction margin dollar growth, which is very important. In other words, the PSP segment is driving higher profits despite slower growth. So imagine how much earnings growth PayPal is going to experience if growth for the PSP segment reaccelerates, which given time, I think growth will eventually reaccelerate. As for the other major segments like branded checkout, Venmo, and other merchant services, growth actually accelerated on a year over year basis, as you can see right here. So we're actually seeing strong growth outside of the PSP business. And as a result of TPV growth, revenue for the quarter was $8.4 billion, up 4% year over year, which beat analyst estimates by $90 million. Growth was driven by branded checkout, Venmo, and other value added services. Again, notice the growth slowdown over the past few quarters, and if you forgot, this was due to management's price to value strategy as they continue to prioritize healthy, profitable growth and intentionally let go of unprofitable volume within its Braintree business. And because of this, management expects growth to be somewhat muted, guiding for flat to low single digit revenue growth in Q1 due to Braintree renegotiation efforts as well as a 1 percentage point headwind from lapping last year's leap day. For the full year, expect the Braintree renegotiations to result in a headwind to revenue growth of about 5 points in 2025. However, PayPal should reach a new baseline to drive faster volume and revenue growth once these renegotiations are done and dusted. In short, expect growth to decelerate in 2025 due to these Braintree renegotiations. However, it's important to note that while Braintree is slowing down, PayPal's branded checkout segment continues to gain a lot of momentum. So, for instance, Venmo continues to display strong monetization progress, with Venmo debit card users up 32% and Pay with Venmo users up 22%. This is important because debit card users delivers average revenue per account that is 4 times higher, and Pay with Venmo users delivers average revenue per account that is 3 times higher. And excitingly, Venmo is only in single digit penetration across both of these products, and that PayPal is just scratching the surface of a very engaged, highly valuable Venmo user base. In addition, PayPal debit card TPV grew nearly 100%, with PayPal adding more than 1.5 million first-time debit card users in Q4. Keep in mind that the average debit card user generates 5 times the transaction activity and 2 times the average revenue per account as compared to users who only use branded checkout. And not forgetting to mention, PayPal Fastlane now has nearly 2,000 merchants as of Q4, which has proven to be effective in increasing overall conversion, especially among new or dormant PayPal users. So, despite the slowdown in the unbranded processing side of the ecosystem, it's encouraging to see that PayPal's branded checkout is making a lot of progress in terms of monetization, in terms of increasing engagement, and in terms of driving more payment transactions. Ultimately, management's price to value strategy in the unbranded segment and improved monetization in the branded segment will drive higher quality, more profitable revenue growth over time, which should generate massive shareholder value in the process. And besides, we're already seeing the benefits from its price to value strategy. For one, despite the slowdown in top line growth, transaction margin dollar, which is pretty much the gross profit of the company, the growth remains robust at $3.9 billion in Q4, up 7% year over year, driven by branded checkout, Venmo, interest on customer balances, credit, as well as Braintree. More importantly, transaction margin, which is the blue line right here, was 47% in Q4, up 120 basis points year over year. And as you can see, it has improved for the third straight quarter, implying higher earnings potential. Not quite there yet, but definitely encouraging to see the trend and the company's progress. That being said, management guided for 4% to 5% growth in transaction margin dollar in both Q1 and 2025. And as a reminder, the Braintree renegotiations are expected to pressure revenue growth by 5 percentage points. But the good news is that it is expected to result in more than a point benefit to transaction margin dollar. In other words, while we may see flat to negative revenue growth, we can still expect positive transaction margin dollar growth as PayPal's unit economics continue to improve. Moving on, non-GAAP operating profit was $1.5 billion in Q4, up 2% year over year, and this represents a non-GAAP operating margin of 18%, which was down 30 basis points year over year and 80 basis points quarter over quarter. This was mainly due to a 10% increase in non-transaction operating expenses to support the rollout of new products and initiatives. In terms of the bottom line, non-GAAP EPS or earnings per share was $1.19, up just 5% year over year. And as you can see, EPS growth is slowing down significantly. However, this still beat analyst estimates by 7 cents. That said, expect EPS growth to accelerate slightly as management expects 6% to 8% year over year growth in Q1 to $1.15 to $1.17. And also keep in mind that this guidance beat estimates by 2 cents. For the full year, expect non-GAAP EPS to be about $4.95 to $5.10, implying a 6% to 10% year-over-year growth, and this also beat analyst estimates of $4.89. So PayPal continues to be underestimated, and I think given management's consistent track record, I think they're going to deliver much better results than what they have guided. So all in all, as you can probably tell, PayPal is making significant progress in the profit department, with transaction margins making a nice comeback. Furthermore, management issued profit guidance that were well above analyst estimates, pointing to robust earnings growth. So this kind of results and guidance should have launched the stock to new all-time highs. However, as you already know, the stock sold off following its earnings release, likely due to the massive deceleration in the growth of the unbranded processing business. I know this is frustrating, but I think investors need to exercise a little bit more patience. I think PayPal will continue to grow. It will return to growth mode once the renegotiations are complete, which should drive strong earnings growth for years to come. And because of this, I think the stock will eventually catch up to its rising fundamentals. And speaking of rising fundamentals, PayPal's free cash flow has also risen to new record highs. In Q4, adjusted free cash flow, which excluded the net timing of European buy now pay later loans, was a record $2.1 billion in Q4 at a 25% margin. Now, cash flows varies a lot from quarter to quarter due to seasonality, so I went ahead and calculated adjusted free cash flow on a trailing 12-month basis, which was $6.6 billion in Q4, representing a free cash flow margin of 21%. As you can see, free cash flow on both an absolute and marginal basis is the highest it has ever been, pointing to very strong, very solid fundamentals for the company. So that's really good to see. And not surprisingly, most of the free cash flow was used for stock buybacks, which I think is the right capital allocation strategy given that the stock is still down 75% from its all-time highs. So in Q4, the company bought back $1.2 billion of stock, and over the last 12 months, the company bought back $6 billion worth of stock, reducing weighted average shares by 6% year over year. And recently, management has authorized a new $15 billion buyback program, which has now increased PayPal's buyback capacity to about $19.9 billion as of Q4. And to put that into perspective, $19.9 billion is about 25% of PayPal's current market cap. So management guided for 2025 share repurchase of about $6 billion, which is flat year over year. But considering its strong balance sheet of $15.4 billion in cash and $11.1 billion of debt and record high free cash flow, I expect 2025 buybacks to be well above management's guidance of $6 billion, thus reducing shares outstanding even more and accelerating EPS growth even further higher than management's guidance of 6 to 10% growth. And I think this will boost its share price over time, which I think is still cheap, especially after the recent sell-off. As it stands, PayPal is currently trading at a PE ratio of 19 times and a price to free cash flow ratio of 11.7 times, which is very cheap for a company with improving profitability, record free cash flow, and record buybacks. Also worth considering is that PayPal is trading at its lowest valuation multiple ever compared to its historical levels, as you can see right here, which is really high. So PayPal stock looks very attractive in my opinion. In addition to that, because of the recent sell-off that we've seen, the stock is approaching the 200-day simple moving average, which is about $74 today, which usually act as a major support and buying zone. So that could be a good time to buy PayPal stock from a technical analysis standpoint. As for me, I'm keeping my base case price target unchanged at $106 a share, representing an upside potential of about 39% based on the current price of $76 a share. So this assumes a 2034 revenue of $56 billion, which is a CAGR of just 6% for the next 10 years, as well as a long-term free cash flow margin of 19.0%, which is below its current free cash flow margin of 21%. So, very conservative assumptions, which makes a wide margin of safety. But put simply, I believe PayPal stock is still undervalued with decent upside potential, whether it's the bear, base, or bull cases, which is why I plan to add to my position in the next few days. Also, if you're interested in following my portfolio, you can sign up on Savvy Trader and follow my portfolio, which gives you real time updates on the performance of my portfolio as well as any trades that I make. So if you're interested, link to my portfolio will be in the description box below. With that being said, I think the PayPal investment thesis remains well intact. So the company delivered strong Q4 results that beat both revenue and EPS estimates. Active accounts, which is a leading indicator of future revenue growth, continues to increase, and more importantly, transaction margins continue to improve as well, translating to higher earnings potential. PayPal is also generating record free cash flow and buying back shares at a record level, and management also issued profit guidance that are well above estimates. So overall, very strong performance in my opinion. However, the stock sold off more than 13% in a single trading day, as investors were not happy with the major deceleration in the unbranded processing segment. Fortunately, this was intentional by management as they implement their price to value strategy to churn unprofitable volume, which should ultimately drive higher transaction margins, enhancing PayPal's earning potential even more. Meanwhile, the stock is still down 75% from its all time highs, with valuation sitting near all time lows. So, all in all, considering its strong fundamentals, I believe PayPal is still undervalued with decent upside potential in the next few years or so. With that being said, thank you guys so much for watching this video. I hope you find value in this PayPal video, and if you do, please leave a like, comment, and subscribe to my channel for more investment content like this. As always, thank you guys so much for watching this video. I appreciate you, and I hope you have an amazing day.